All right, test one, two. Joel, can you do a quick audio test? That's Dennis. Oh, wait. Alrighty. This is a quick audio test. Joel, can you just give us a quick test? Oh, Joel's gone. All right, Dennis, quick test.
Testing 1 2 3. Testing 1 2 3. Testing audio.
All right.
All
All right.
right, testing 1 2 3, testing 1 2 3.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, traders and investors. Welcome to this Tuesday, February 28th edition of Benzinga's Pre-Market Prep. I'm Spencer Israel here with Joel Elconin and Dennis Dick. They are still, for the second day in a row now, they are calling us from New York City, where they're at the New York Traders Expo. Guys, how was it yesterday? Tell us what you guys, before we get into the show, what did you guys do and who'd you meet? How was your first day at the Expo?
Joel, that's your cue, because I'll tell you, our first day, the expo is great. The one problem I've got here is my internet connection isn't that great, so I'm limited with my market information. Joel's probably trying to type to me on Skype and saying, you go, but I can't have that up because I'm literally on my cell phone here right now, so it's going to be a little bit awkward here because me and Joel usually communicate the show by talking to each other and say, you go, you go, you go, you go, and there won't be any of that here today, so I'm just going to throw it to you, Joel. Tell us, about, our day there yesterday, and then I'll jump into it as well.
We had an incredible day. I am well rested. I got my jammies on early last night and got a good night's sleep. Walked the New York City streets, got some breakfast this morning. We talked to Kenny Glick of HitTheBid.com. We talked to Day Trader Radio Options. We talked to the people at EF Hunt and the Chicago Mercantile Exchange. We covered the whole gambit there. A lot of great people, lot of characters here. We paid a visit to T3 Trading, met Scott Red Dog Redler. Beautiful office there, and I got a little treat for you guys when I get back. Scott and I did a little video on the markets in the studio there. I'm a rookie at it, kind of had a cheesy smile a little bit as I was informed by...
He's got the face for radio. Joel has the face for
do.
radio. We realize this now after we put him on video.
That's good. That's good. All right. Let's get it right to the markets. Got a lot of news this morning. We have Kite, some data out of them. We have a lot of earnings too. Target is your disaster stock of the day. Valiant, Domino's also reporting. And then after the bell, we've got Etsy, AMC, Weight Watchers, Sarepta, Taser, Salesforce, and more. In ratings land, we have a new rating from Gordon Johnson on the solar sector and an upgrade to Hershey. So let's just jump right in. And let's start. We gotta start with Target, I guess. So here's the number.
Gotta start with Target.
Let me pull up. I don't know why I haven't.
Tell us about this Target report here, because I flip it on and obviously I'm running in a skeleton operation. Normally I've got my 8 screens up. I've got 3 computers running. I got my laptop running right now. I'm running on a laptop that is blowing up on me and my iPad. So I'm very limited, but I flipped on CNBC. I do have CNBC, obviously, in my hotel room. I flipped it on early this morning. I was like, whoa, Target down 13%, something big. And obviously I knew that earnings report. I was like, they must have said something really bad. So Spencer, what did Target have to say?
Yeah, so Target Q4 EPS $1.45 versus $1.51. Sales $20.69 billion versus $20.70. That's not so terrible. The guidance was the doozy. Q1 EPS 80 cents to $1. $1.33 was the estimate. Fiscal year EPS $3.80 to $4.20. $5.34 was the estimate. Comps for the fourth quarter were down 1.5%. The big thing that the CEO said on the call in a prepared statement was just, obviously same story. The rapidly changing consumer and the unexpected softness in their stores is what they said. So yeah, obviously a big cut to the guidance there, and that right there is your disaster stock of the day.
You know what? I have not liked this stock for a long time, and I was short it multiple times for a swing trade in the 70s, and I just could never get the timing right on this thing. I was way too early on it 2 years ago. I remember being short the stock in my swing account at $77. And you know what the Target does is they had stores in Canada, and I was like, these stores are a disaster in Canada. Nobody's going. They couldn't get the inventory. It was a complete mess. And they bought out an old retailer, Zellers, in Canada, to come into Canada. And it was a big, expansion for them. They ended up shutting it down after like 6 months. They just basically pull the plug on Canada because they realize it sucks. And, I shorted it on that news. It popped a little bit on the news, and it rallies 10% on that news. And I was like, this market is, and I honestly couldn't hold through that. I mean, I'm not going to, take the thing, just let the losses just roll against me. And, it made no sense, though. Like, when you stop and think about it, we're taking a $5 billion write down here for Canada, and they're going to rally it because they're closing the Canadian stores. I mean, they rallied when they were going to expand into Canada, and then they rallied the stock when they were going to close the stores. The market can sometimes just be very irrational. But again, the old saying, the market can stay irrational much longer than you can stay solvent. And I just couldn't hold on to this trade long enough. And, so I kept trying to be short Target 2 years ago. I probably, if I would have held this long, I probably would have had too many short fees. Anyways, the borrow fees probably would have ate up the profits. But here we are. We're back at $58, and I look at it, and man, I just had the timing wrong on this. But Joel, technical thoughts here as Target breaks down 13% today.
All right. Well, we are not going to have a real technical show, as I'm having a few computer issues as well.
I've got a chart. I can give you. I got a little mini chart.
Here, I got a chart.
Normally, I got all my screens.
I got some too. I'm just not gonna. I'm not gonna flip symbols. Well, for all our traders that are looking at the pre-market action, I can tell you the low is 56.80. Getting a little reprieve here. I can't get back in the 60 handle. So keep an eye on 56.80. 59 and a quarter is resistance. And then you folks know what I like to do. And you get these big moves. You got to go farther out. Go to your weeklies and your monthlies and see if you can find some support here. But I'm just going to keep my computer on the 15-minute here so it doesn't bog down.
Some good.
Yeah, and
I'm sorry, Dennis.
And I was just going to say, obviously, here, we got to go into sympathy plays here, Spencer. So we're not going to let you just run away here on us yet. Because obviously, you're going to hit it. A lot of the retailers are going to get hit here today. So just, off the top of my head, because, again, I'm limited with my information. But obviously, Walmart. Walmart has already traded down 1% here in the pre-market. They had a report that was okay, and they rallied the stock on it. But then it started to leak again, even after the report. Macy's is trading down 1.5% here this morning. Kohl's is down almost 2%. They've had a pretty good run. I mean, those stocks actually came back a bit. Now they're getting weak here. And then you got Nordstrom here is trading down, Dillard's. So, when you see, a major big box department store like Target there, retailer, it's going to hit the other stocks in the sector. So you got to be aware of that. The question is, and I'll say it again, on normal markets, and not this big raging bull market there, usually you'll see continued weakness throughout the day in some of these stocks. But because this market's such a buy the dip, now forget about Target. Target's got all kinds of its problems, but I don't know if it's going to be a continued follow through here in the sympathy plays. I've been talking about this on the show for a couple of months. Sympathy has been a hard trade lately. Like typically, I make a lot of money with sympathy trades when I'm shorting the other stocks in the sector. But that trade has not been working as well as it has in the past. And just because we're in this raging bull, sometimes you get bad news in the sector. Other stocks might open weak, and then by noon, these other stocks are trading higher because other people have come in, portfolio managers come in just because they're hungry and they're looking for buy the dip again. But anytime you're shorting this market, you're fighting the tape. Even if you're shorting the stocks that are weaker sectors, it's still an overall. We're in this bull run. And shorting has been very difficult. So, the sympathy on the short side has been a tough play. That's all I'm going to warn you if you're coming in here and shorting all the peers today.
And then
Dennis, how we talk about, like who goes in these stores and who buys all this stuff? I mean, I can't remember.
Where do you shop? You don't shop at Target? I was at Target a few weeks ago, and I don't even shop.
I've been to Walmart once in my life to buy beer when I was in Florida. I've been to Target.
Where do you buy all your stuff? You don't buy on, or you buy everything online now?
Well, Lisa buys a lot of stuff, but I'm telling you that we get that Myers, the
Myers
ship.
Awesome.
Yeah, so they deliver it to our house. Sometimes we get groceries like at 10 o'clock at night. Myers, there's a Kroger by us, but I mean, I just don't go. I mean, I don't buy luggage. I don't buy clothes there. I don't buy anything in these. I guess I just don't buy anything. But looking
like Target is really, just to let you know, Joel, because you don't go into these stores. Like I feel like Target is a nice Walmart. I feel like that's what it is. Like Walmart, you come in there and it kind of feels trashy.
I want to say
where Target is very nice. Wouldn't you say that, Spencer?
Yeah.
I would call Target like a souped up, nice version of Walmart.
So this is actually a tweet that I saw. This is from Rahul Sharma. I follow him on Twitter. He's at retail_guru. This guy is a pretty good retail analyst, and he's got what I think is a pretty good take. Target is caught in the headlights between Walmart and Amazon. Not enough food to keep store traffic up, but not enough non-food wow to compensate. And I kind of agree with that. It's like half food, or it's like a third food, 2/3, other stuff. And so yes, Target is a nicer Walmart, but they're sort of in no man's land right now. I thought that was a pretty good observation there from Rahul Sharma. Also, no.
The other thing,
yeah,
I was going to say the other thing is they're just huge stores. I mean, we've had, a lot of these big department stores have had difficulty. And you can't really call, a Target's not like a Macy's, but it kind of is a little bit in that they have a huge clothes section as well. A little bit more discount clothes than what you're going to see at a Macy's or a Nordstrom. But, it's kind of just got the same problem that all those other stores go. The stores are so big.
And Joel, you had a comment? No. Okay. Target is at its lowest level right now since August 2014. So keep that in mind. Moving on now.
One more, Spencer.
Right,
I'm sorry.
Go for
one
it.
more.
Go for it.
Last time I was at Target was when Emily's getting ready to go to school. We went and bought, all the stuff for her apartment. And for you Gap traders, keep an eye on the higher 69 handle in Walmart. You had a gap up of earnings. So if you're looking for that gap fill, you just may get it today in Walmart.
All right, we spent 12 minutes on the big box retailers here. Spencer, where are we going next?
Let's go to Valiant. They reported VRX did Q4 adjusted EPS $1.26 versus $1.21. Sales of $2.4 billion versus $2.34 billion. So they beat on both those numbers. They see their fiscal year 17 sales at $8.9 to $9.1 billion. That's in line with the estimate. So overall, let me pull up not a weekly chart. Let's do a 5-minute chart, a 5-day chart. Look. So there you go. Wow, that's some yo-yo action.
Joel, do you got the pre-market chart on this thing? Because obviously, again, I'm limited in my charts.
Here,
what's low pre-market?
I got your low, 15.5.
15.50?
Yeah.
So we come off those lows. What's it look like now? You got to describe the chart to me because I don't have a visual.
All right, here.
So it's coming up here from I have the actual day chart, but I don't have the pre-market chart.
It's coming up from the low. It was at 1747, dropped down to a low of 1550. Now it's coming back up, and we're knocking on the door with 16.
What we have seen happen multiple times, and not that Valiant can't be its own animal because it's always its own animal, but what we have seen multiple times is some of the laggards that have been reporting here over the course of the last couple of weeks have got hit initially on their weaker earnings report and then come back. Now, Target obviously doesn't fit that bill whatsoever, but the stocks I'm talking that, fall like 2% on their earnings report. I was thinking of Teva. It was originally down and then it ended up being, a lot stronger on the day. And there was a few other ones, that we've seen the example of this happening there. And it wouldn't surprise me or shock me if they came back here and bought Valiant again. Anybody who's short this thing, it's kind of run up here over the course of the last, couple of months, and it's turned the tide a little bit. Like in the last month, we went from 13 to 16.5. So imagine, now you're the guy that's short. You kind of got run over here in the last month, thinking Valiant's going to be a zero and it's going the other way on you. Pulls back a buck and a half here this morning. You're like, okay, I'm going to bring some in. So what you can see is a little bit of short covering that can actually cause the stock to come back to scratch or to flatten. I wouldn't be surprised if that happened today, but Valiant is a wild child, and anything can really happen. So obviously, it's just using analysis from other stocks that have been disappointing over the last little while, that have reported disappointing quarters, have actually been bought on the disappointing news.
I have the number of the day, the number of the week, the number of the month, and maybe the old $15, Dennis. And you are going to love this. Right. Low of 13 on the move. We've gone up to a little over like 17.5, right? I love my 50% retracements. That comes in at the 15 to 15.25 area. You had a couple lows in that area. So that, not only today, but $15, especially if you're going to try a swing trade here, you're looking at 15. You're like, this is finally the bottom in Valiant. You're out is 13, and don't think it's going to go back to 264.87, which was the top in it. But if I had a short, I'd be bringing it in. Really like the $15 area.
I think there's going to be a lot of buyers in the 15 handle, and we are finding, obviously, Spencer saying the low 15.50 in the pre-market. It's trying to get back up there into the 16. It's just hanging out there right now. But I'm not coming in here shorting this thing in the 15 handle because I think there's underneath demand in here just from people who have been short, and like you were saying, the 50%. So I wouldn't be surprised if this thing had a bounce back.
All right, let's move on to another earnings stock. Priceline. This is from yesterday now. PCLN. They reported Q4 EPS, adjusted EPS of $14.21 versus $12.98. Sales $2.348 versus $2.32 billion. So they beat on both those numbers. They see Q1 adjusted EPS at 8.25 to 8.65. $10.56 was the estimate on that. So a bad Q1 number there. They do see profit, or their profit was up 21%, I should say, in the quarter. So let me pull up a chart there of PCL.
Can't be too much bad with stock trading up 69 points here in the pre-market. 1701, new all-time high. Joel, what do you got for an after-hours high? I always look at Priceline, and I think this thing always moves $100 on earnings. Did we get up to like the 1730 area to move that $100?
No, sir. 1714.
No,
Here's the range on the first bar. 1714. 1610 to 1714. That's just in that 15 minute
100-point range on the first bar. That's
you know what? I got to go to a shorter term chart, and I hope this doesn't mess up too much because, 5 minutes within the 5-minute bar that had a 104-point range. Only one number to concern people with in this stock, 1714. That's your pre-market high.
That was after hours last night when they reported their hours. Got to correct Joel when he says pre-market, but this was after hours at 1714. So, yeah, keep an eye on that. I mean, it's trying to hold 1700 here. Priceline's always a wild child. The good news is we're going to get some options analysis on Priceline when Nick Shaheen comes on 8:35. Priceline is one of his babies there. So we'll get the full analysis from the Priceline specialist coming on at 8:35.
Let's roll through the earnings stock still. We got Domino's this morning as well, and that came on the heels of some comments that got yesterday from the Reverend Emmanuel Lemelson. He does not like the stock, says Domino's is not worth more than $60 a share. So let's go into the earnings number. Q4 EPS $1.48 versus $1.44. Sales $819.43 versus $782 million. So they beat on both the Q4 numbers. They're also increasing their 3 to 5 year outlook from 2 to 5%, and domestic store sales growth up to 3 to 6%. So Domino's trading up in the pre-market this morning on that report.
I always say it when we have this every quarter, I'm a Domino's fan. I mean, of all the chain pizza joints, and you can always get little good individual joints, that have pizza, but out of the chains, out of the majors there, the best bang for the buck and the best pizza, I believe, for the buck still is Domino's there. Because when you go to a place, and for instance, at my cottage that, I'm up in the summer there, I've tried to find a good pizza place up there, and there's 4 or 5 local places, and they're really expensive, but not they were very good. And you know where I go? I go to Domino's because I know Domino's is going to be cheap and it's going to be good. And even when I'm at home in my regular, a lot of times I saw my wife obviously and my 2-year-old son get a large pizza. I get delivered to my house for $13. I mean, how can you beat that?
Pre-market high has exceeded the all-time high. The all-time high was 189.88. The all-time closing high, 88.32. Just giving you your pre-market high was above that. Your pre-market high was in the 192 handle at 192.68. But you have a couple red bars here, so not sure if we're going to get back up to that 192.68 level. I mean, you can have your thesis on the stock about where it's going long-term or short-term, but, it's kind of hard to fight the tape in this one.
Trend is your friend on this thing, and you've seen the stock go from the last 5 years. It went from $30 to $190. I'll tell you, when stocks start going to $195, they almost always want to go to $200. That 200 starts to act like a magnet at a certain level. So if we can get up there and start trading actively in the 190s, and I don't know if it's going to do there today, you start thinking, man, this wants to see 200.
If you're interested in the bear case, I just posted a link to our article with the Reverend yesterday.
So what was the Reverend? Why is he bearish?
He definitely thinks that pizza stocks are in a bubble as a whole. But does not like just the capitalization of Domino's business.
And you know what? Long term, he might be right on that. I mean, this thing is an incredible run. And if you're coming in here investing in Domino's at $190, you're very late to the party. A year ago, it was $130. We go to 2 years ago, as trading down $100. I mean, it's been straight up, but hard to fight that tape. So and the trend, where I say is your friend. So until you start seeing that trend get broken, it's hard to fight this thing on the short side there. But he fights a long time, and he's fought some good battles there in some stocks. And obviously, some of those have come back, nicely for him there. So, it depends on your holding period always, but, I'm pretty short term, and I don't like fighting the tape when things going straight up.
All right, let's move on to another earnings stock, but also had some data this morning. That's Kite Pharma. So they met the primary endpoint for a drug this morning, and shares were halted just before 7 a.m. Then they also
still halted.
Okay, still halted. Excuse me. Then they also reported earnings a few minutes ago, right at the top of the show. I'll give you that. Q4 EPS of $1.31 loss versus $1.75 loss, so they beat that number. Sales 4.9 versus 5.6 million, so they missed that. You can see though on the 1-day, 1-minute chart, not a whole lot going on this morning though, but I did say that they met the primary endpoint of the objective response rate for their DLBCL drug.
You usually met primary endpoint usually equals a pop, but you did have earnings in here too. So we'll have to see when it comes out of the halt. I don't know if we can hunt down the time for when this thing is estimated to be coming out of the halt. If the chat knows, you can pop it in there as well. Of course, because my other computer blew up, so I'm having difficulty seeing the chat, but Spencer's monitoring the chat there. So again, when the stock's halted, it's very hard to give you a technical analysis because it's got fundamental news. And this thing's going to gap one way or another. I tend to think it's probably going to go up if they met that primary endpoint, but I don't know the details on that.
I will know. I mean, look at what it did yesterday, though. I mean, yesterday it had a huge day. So
it did.
Yeah, it was running up big time, 53 to 57. So maybe some of this is expected.
Went right off the board on Friday at 56.83. Do see a couple highs just under $58. So those are my two levels to keep an eye on in Kite Pharma. But more interestingly, and I want to get Paul Yook on the line here next week. Spencer, remind that he's our biotech expert. But how long have we been talking about $300 in the IBB? Take a look at that chart. We've hit it 4 or 5 times here over the last few months. I might go do some crazy call spread. I'll talk about it with Nick, maybe like a 300, 320, call spread, giving myself a couple months, looking
You looking
out
for the big breakout over 300?
Yeah, maybe. I mean, I'll play it that way. I mean, I always look at this stuff as resistance, and then it blows through it. But that 300 is an important level. We'll talk about that with Nick when he comes on. But Spencer, I just want to tell you one other person that we ran into yesterday and had a nice chat with.
Who's that?
Phil Davis. Phil Davis from Phil's Stock World. He was telling
about
Phil's World. He was telling us about a nice Tesla spread that he had on put spread going into earnings. So that was another person we ran into at the Traders Expo.
I'm sure we'll cover Tesla with Nick. Yeah, Dennis, you had something?
I wanted to just jump over to because I want to do an imbalance talk. I actually had somebody just tweet at me the last couple of days. He wants to know more about imbalance strategies and trading the imbalances there. So I am going to do a little session here in a few minutes on that. But before we get to that, I want to get to the one big downgrade here of the day, which is our buddy Gordon Johnson. Spencer, what does Gordon have to say?
Well, it's not a downgrade. He's initiating First Solar at
initiation. Okay.
Yes, at a sell.
First Solar at a sell. Gordon, we know, has been bearish in the solar sector stocks for a long time. But I'm surprised he didn't have a sell rating on this one already. He's had a sell rating on all of them, hasn't he?
You know what? But remember, he did have that temporary buy rating.
Yeah, he got a little bullish there, right?
So,
here
I don't know, but they're here.
First Solar here trading down $1.30 on Gordon's initiation there at a sell. I mean, this guy calls it how it is. He's always great when we have him on the show because he doesn't sugarcoat anything there. And you know what? It's great about him. He's not afraid. So many people on the street are afraid to throw sell ratings on stock. And when he doesn't like something, he says sell it. And, he calls a spade a spade. That's why we love Gordon Johnson. But, Joel, give us technical thoughts here. First Solar is trading down $1.50 here this morning.
Yeah, trading just hanging out at the 36.50 level. We've had about a 10-point rally off that 28.60 low. So you know where I'm going here. Longer term, if you're looking to cover short, the $32, $33 area. just throwing in another fundamental here. I mean, I'm not sure if we're going to get any direct information from the speech tonight, but I don't think the president of the United States is going to be doing a lot of. There's a lot of subsidies coming up for these stocks, and if these subsidies, I mean, I'm not touching this on the long side, not necessarily saying it's a short, but fundamentals working against First Solar. I agree with Gordon on this one.
What's that Jim Cramer's got that not a Trump stock button? That's what I would say with First Solar there too. Definitely not a Trump stock. So Trump speaking tonight. I don't know if I'd want to own solar stocks into that.
All right, it's 8:26 now, about 10 minutes before we bring Nick on. So Dennis, why don't you fulfill that request you got yesterday and give us
let's just do a quick 5 minutes. So we talk about these imbalances every day on the show, and today is an unfortunate day because obviously my laptop is blowing up here and I don't have the imbalance data here again. I will have it for you tomorrow. We give it every day on the show when I'm not in New York and I'm in my normal office. But 8:30 is when the imbalance data originally posted. You will often see moves in stocks right at 8:30 because the ones that have big opening buy imbalances might be moving up. The ones that have big opening sell imbalances might be moving down. So let's just do the whole thing and start right from the beginning. What is an imbalance? So basically these imbalances I'm talking about are orders that are for the open. So you're looking at a stock, let's just say stock GE closes at, here I'll bring up, what is actual GE close, Joel? You got it in front of you there? Give an actual example, 29.94. So anybody who puts a buy order in for, and not talking for pre-market, that's for the regular hours. If they put a buy order in for 1,000 shares at 29.95, that will add 1,000 shares to the buy imbalance, to the buy side. If somebody comes in and puts 1,000 shares to sell at 29.93, that will offset it. So now the imbalance will be net zero. So it's all relative to the closing price. So basically, if you see a GE comes out, just hypothetical example, comes out with 50,000 shares to buy, that means there's 50,000 more shares to buy relative to the closing price than there is to sell. What traders do, what that basically is an advertisement to traders to try to provide liquidity to this. They're saying there's a buy imbalance here. So we're advertising out there, the designated market maker on the floor is advertising out there saying, look, we got 50,000 or 100,000 shares to buy here. Basically, help out if you want. So what, the natural trade is, this is one strategy, and there's lots of different strategies around these imbalance data. But one strategy is to provide liquidity to those imbalances in the open in the hopes that a stock might open too high if it's got a big buy imbalance. If it's got a big sell imbalance, I might be buying, and providing liquidity to the person who wants to sell. There's a big institution maybe that wants to sell it at the open. So maybe the stock's going to open too low relative to fair value. So it's all about a fair value you trade. And, when we get into fair value, that's a completely different conversation, but it's related to this. So let's say, for example, all hypothetical examples here today. But let's say the market is trading up 0.5%. GE's correlation to the market is very close. So you're talking about a stock that, it's very, very close to what the market does. So on any given day when the market is trading up 0.5%, GE will often be up about 0.5%, if there's no individual company news on it. So the strategy there is that maybe there's a big buy imbalance. Maybe GE opens up 1% and the market's only up 0.5%. Well, there's a statistical, arbitrage possibility there where you could short GE at the open, buy the SPY against it, and then wait for that 0.5% to try to come in. That's all stat arb, and that's all stuff that we do at Bright Trading. These are the types of strategies that we employ. We're not so much concerned about in one individual stock. We're concerned more about the relationship, the relative value of that stock related to something else. In this case, it would just be GE to the overall market. But so one strategy is when you have a big buy imbalance is to provide liquidity to it because it might potentially open too high. Now, when I'm placing that order, I'm not just going to flat out say sell short GE at the market. I never use market orders like a blank ticket. I want to be selling GE only if it opens too high. So, for instance, if I deem GE's fair value to just say $30 or $30.05, I might offer the stock short at $30.10 or $30.15 because I've deemed it, with my, systems and looking at the fair value calculations that I think it should open around $30.05. It opens at $30.15. It's open too high, and that's why the statistical probability of it coming in is greater than for it to continue. That's one strategy. Now, the problem is there's always, a double-edged sword. The problem is when you have a really big buy imbalance that's posted in the market, a lot of other traders, short-term traders, are seeing that same imbalance. What can happen is that the trade can often get crowded because you have maybe one long-term investor that is coming in, and saying, maybe it's Fidelity. They want to buy 200,000 shares of G, and they don't care. They're not going to sell it here today. They're buying it for the next 5 years. Well, you have all of a sudden, a bunch of day traders or a bunch of short-term traders coming in and providing liquidity. So they're selling, basically 200,000 shares worth of stock. So all of a sudden, you have a whole bunch of short-term traders who are actually short the stock. What can sometimes happen if it gets too crowded, that you can have a little bit of a shakeout in the stock. There might not be the liquidity there. Some of the other traders that just short are like, something else is going on here, and they might scramble. And sometimes you'll see a little pop even afterwards if a stock opens too high. That's the shakeout. And then sometimes, after when the dust settles, it often comes back in. But nothing is, straight up, that you can always do. We always live in the probabilities as traders, and nothing in the absolutes. So nothing is going to work 100% of the time. But if I have an edge that is correct 53% of the time, I can make money just like a casino. If I have that edge and it works, with a 53% probability, I probably can make money in that strategy in the long run. On any given day, I might lose on that strategy. On any given week, I might lose on that strategy. Highly unlikely for me to lose on that strategy over a year, because when you employ a strategy with a statistical probability enough times, it will probably work out in the long run in your favor. But you obviously have to be capitalized enough to be able to take the short-term hits when the strategy is, not working in your favor. Just like a casino can, lose money on any given, slot machine, they can lose money. But overall, throughout the year, those that 53% edge will help you out. So that's one strategy. You got to be careful with the crowded strategy. Another strategy just around the 830 imbalances is people will flat out, buy the stock in the pre-market. So you'll see a big buy imbalance all of a sudden pops up on GE. You will see GE move up at 830, a few cents, because people are speculating that the stock is probably going to open high. Now, you got to remember, imbalances is just one pinpoint in time of information. You might see GE with a 200,000 share buy imbalance. Templeton might come in and say, you got them, and they sell 200,000 shares, and all, and all of a sudden the imbalance will drop to zero. So this information can change. It's not static. It's, always adjusting for new orders that are coming into the market as well. So just because a stock has a buy imbalance of 200,000 shares at 830 doesn't necessarily mean it's going to continue to have a buy imbalance for 200,000 shares at 930 when the stock opens. More orders are going to come into the market. Institutions sometimes lick their chops. If you're a big institution and you're worried about price impact, you see 200,000 shares to buy and you need to sell 200,000 shares, you might actually come in and provide liquidity at the last second for that, and the imbalance data can change. So that's the consideration. It's one tool in your toolbox. It is information, and there's lots of different ways to use that information. But at the same time, you've got to be careful because that information changes. It's not static, like I said.
All right, just a couple points on that before we get Nick Shaheen on.
Joel?
Did we just lose Joel?
I don't know, but I had a question actually from the chat, Dennis. Ethan,
sure.
Ethan G asked, how do you check these imbalances? Is there a website where you check them?
Okay, so it's actually from there's at 8:30 the New York Stock Exchange imbalances come out, and actually it's not till 9:28 on NASDAQ stock, so they come out quite a bit later there. So you don't have as much time. That's why I often focus on the NYC stocks, because at 9:28 you don't get the NASDAQ imbalance information from, and then you got to move really quickly because you only have 2 minutes before the open. So you almost have to be automated to trade the imbalance data on the NASDAQ stocks, or you have to just pick one or two. It's very difficult to do 50 stocks in 2 minutes if you're a manual trader. But so that's where the information is coming from. You should be able to subscribe. A lot of retail platforms do offer this information now. Check with your broker. Ask them about the imbalance data from the feeds. You can just search it. If you don't have that information, like I get it from my prop feeds, I get it from Ready Plus, which is the system that I use. If you don't, Rosenblatt, and I talk about Rosenblatt all the time, they do have a retail product that you can subscribe to for $100 a month. So just, Google Rosenblatt, or you can put, maybe tomorrow I can put that link in the chat. Sometimes I tweet it out as well. The great guys over at Rosenblatt, and they do offer a retail product for $100 a month that will give you that information. So it's called the Rosenblatt Imbalance Tracker. Rosenblatt should be giving me kickbacks on this.
Yeah, they should. All right. 8:34 now. We're going to take our first break for Nick Shaheen. Also want to note that we're going to get Gordon Johnson on at 8:50 after Nick to discuss his first solar note this morning. So we'll be right back with Nick Shaheen first, though. He's our options guy, our go-to options guy. He's the author of Create Income with Option Spreads on the Marketify platform. So we'll be right back with Nick. right, welcome back, traders and investors, to Benzinga's Pre-Market Prep. I'm Spencer Israel here with Joel Elconin and Dennis Dick, and we're on the line with Nick Shaheen, the author of Create Income with Option Spreads on MarketFi. Nick, how's it going this morning?
Going great. No technical issues on this side, luckily. But looking at the market, little dip, but maintaining a huge run, that's pretty impressive.
What about this market? Before we get into Priceline, because we only did Priceline specialist, this market is driving me crazy, Nick. I mean, it pulls back 5 points, and everybody's got, you got to buy, you got to buy. When is this going to end?
Yeah, really, right? Well, I don't know if I'm pretty sure we talked about it, but you have, since we're running on fiscal promise and policy promise, so basically, when we did the monetary actions where the Fed injected money into the system, the delivery was guaranteed. I mean, they were going to do it. They were buying X billion a month, et cetera. But the effects of which were debatable up until this point. You have a lot of people who say it didn't work. Whereas in this case, it's different because the fiscal promises are iffy as far as delivery. But if they go ahead and spend them, I mean, the money's going to hit the streets and it's going to have an effect. So, but will it happen and how much of it will happen? You know, as far as where it can go wherever it wants, really. Technically, it can go to the early 2400s based on just the chart itself. And but we cannot disprove this fiscal spending from coming for another month or two, right? Because he keeps promising stuff. And how can you say, well, it's not going to come? Maybe it'll come or not. Tonight's speech maybe will shed some light on that, but you can't short it really without a reason. So find specific reasons to short specific tickers if you want to short the market rather than shorting the indices.
Yeah, very difficult trade on the short side there. And Priceline here, let's jump into your baby. They've reported earnings. It's popping 63 points here this morning. Were you playing this in the earnings? Did you do any lottos or anything on this, Nick? Or you hands off on the Priceline report?
Well, I did throw in a lotto. It didn't fill, thank goodness. It was a negative one. So I got lucky with this one. I was just going to short it with free money. And
I like shorting with free money. Tell us how you short with free money.
Well, basically, the idea is you buy a shorter dated direction. In this case, I chose put, and you sell a longer dated put that you think will hold up on its own fundamentals. So, for example, if I know that Priceline won't breach 1250, then I can sell that 1250 put, collect a ton of money, and buy a shorter dated bet up or down, whichever one I do. So it's kind of like I did that with a couple of other plays this year, and it pays if you get it right, it pays, and if you don't, it doesn't cost anything.
Is this one you always have options written on because you trade Priceline a lot? Are you always got a position on in Priceline from your options?
By always, I hesitate to say yes on that one because it puts people into the position of trying to do the same. And if you sell strangles, if you sell longer dated strangles than this one, and you know how to manage the risk, it's a money maker. I'll give you an example. Yesterday, I could have sold a plus or minus 30% strangle and collected $60 per contract.
Can you set that up for us, just for the people who might not understand a strangle? Maybe you can just give us the specifics.
Sure.
On
the
that,
strangle is you sell a put, say at the 1260, and you sell a call at over 2,000, and you collect the premium, and you want price to stay in between those two things that you sold. So it's basically an iron condor but naked. So on the downside, if it goes to zero, you're on the hook from wherever leg you sold. And on the upside, if it goes to 1 million, you're on the hook from whatever lever you shorted. So in theory, Priceline is a pricey stock, so margin requirements will eat up. So when you're selling naked risk, then there's a formula where they say, okay, for every contract you sell, I need to reserve X dollars of margin just in case. And that number can vary, depends on the VIX and what happens with the stock price there. So that's why when you sell an iron condor, which is basically taking the same thing, where a bullish and a bearish position at the same time, and you want price the same between both, the maximum risk is set. So the margin requirement is set. If you do 10 contracts of a $10 wide spread, then you're going to require 10,000 in margin, and that's it. It can't change. And if it goes to 1 million or to zero, that's the maximum you can lose, 10,000 minus what you collected. But when I sell a strangle, I'm open to more losses than that.
Nick, let's jump in the technicals on Priceline here. We're getting a gap up here of 58 points here this morning. Stocks trading new all-time area, 1690. Did get up to 1714 last night, so it's come off the after-hours high here. But technically speaking here, what are you thinking on Priceline?
Well, it has a habit of spiking and then just falling. But on the fundamentals, you need a reason for it to fall. They always deliver. They usually underpromise. So don't short for the sake of shorting, especially in this uber bullish market. I'd give it a day or two, or if I wanted to short it now, I'll find a call spread I can sell way high, way out in time. I don't try to do short-term plays on Priceline because it moves $100 a day. So I want time and distance to help me manage the risk, meaning I want time like go out. I don't do the weeklies. I even can do the leaps or end of year type of thing and go up in price to where I have a 90% statistical chance of success. You mentioned in your great, by the way, rundown on how to play your morning plays there. If you put statistics on your side, they're there for a reason because they work more often than not. So why start a trade? Like I see a lot of people that get tempted to sell a credit call spread, for example, which is a bearish play, and collect a lot of premium. Well, they say I'm not risking a lot. Yes, but it's gambling because your statistical chance of success is about 50%. So might as well go to Vegas and put it on black and
put on black or red.
Yeah. I mean, I don't understand that type of quote investment. It's not investment. It's gambling. Yes, it can pay a lot, but what's your edge? Unless you have a reason. Like if you see a wall for a reason, then okay, yes, you do have a thesis and you're playing your thesis. But if you do it just because it's so high, I mean, get a better reason to do it.
It's a great point you're making here. And I mean, a lot of people give the analogy of the stock market as a casino. And if we are running with that analysis, you want to be the casino. You don't want to be the player, and that's the biggest thing here is there's so many people who come in and they want to get rich fast. They want to, put their money, on, a long shot bet, and they want it to come in, and they're buying, out of these money calls, or they're buying, options here. And a lot of the options actually expire worthless. So, you've been on the opposite coin of that for a long time where people are taking these outside bets, on a shot, they want to, turn $1,000 into $10,000, and you're willing to, you're willing to take in that $1,000 and give them that other side of that bet. And it's worked for you for a long time, Nick.
You were the one that said it best one time, a long time ago. I can't remember. You said selling lottery ticket to somebody else. So it was selling, hopefully you're selling losing lottery tickets to somebody. And if you remember when Apple was down under 100 and approaching 90 and everybody technically started calling for 75, yeah. I said I'll sell you that lottery ticket any day of the year. I got paid over. So somebody bought a put that I sold at $65 for Apple. And at the time it was a leap. Like I sold it for this year's February, I think, or March. I can't remember. So I was like, I'll take that money any day of the week. I wish they would sell it down there again so I can do the same. And these are the type of trades you set and you forget because mathematically it works out in your favor any which way you slice it.
We got Joel back there. I think Joel was sneaking in the background.
Hey guys, how you doing?
We're doing great. For a bit. The dicey internet connection, but Joel's back.
I downloaded Skype on my phone all by myself.
I get that. That's what I had to do too. None of our laptops work on this internet connection we have here, so we're all on Skype on our phone. It works pretty good.
Did you guys talk Forge yet?
No, we haven't even got off Priceline. Me and Nick just been having a great conversation.
We're waiting for you. You also mentioned IBB. Hey, Joel, I sent out a note yesterday about IBB that it could be a good long, maybe a little early, but it was a good long a few days ago too, but I just ran out of time. Yeah, a debit call spread would be worth it and even finance it with a credit put spread, but well-placed credit put spread. So basically you can be long for cheap or free.
All right, I'll take a look at that. I know you've been following Fords pretty closely. Had a couple down days, still trying to break out here. Is this thing, the March is just not going to be enough time?
Well, yeah, the reason is still there. It's still technically attractive to me as far as setup for Ford, and it's easy to see just by looking at the chart. I just posted it, but I don't see. There it is, and it is, you know, you have lower highs knocking on the floorboard, but now you have higher lows too, coming to a pinpoint area where they have a chance to break out of the lower high trend. Maybe they can overshoot higher. I was hoping that the Tesla, gives it a little oomph, but it went the wrong way. So, but I'm still hopeful for that. I mean, there's no reason to get off of what you have.
What about that Tesla? I mean, here we are, we're, a week and a half later after the earnings report here. We've got a downgrade from Goldman Sachs yesterday to sell, and we're looking at, everybody's looking at 285 and thinking about 300. Now we're back here at 244, and people are like, ooh, 40 points from the highs here. What do you think, where do you think Tesla's next chapter is?
Well, Tesla, you have to look at it. You have to snipe entry points if you like the bet, and it is a bet, and not as a car maker, because I beat that down to, they need several miracles to be a successful car maker on its own, financially successful car maker. But if you look at it as a company and as the Wall Street likes it, the exuberance in it, and longs should be sniping entry points, and there are zones of interest, and it just entered one, which is a kind of like questionable value zone. Technically, I see why it's here, and I shorted it into the earnings, but I'm not too worried about pressing the short here at all. I booked my short since then, but you can see that it's almost like a no man's land. But if you know it, and if you believe in the bet of Tesla long term, then I would start chomping a little bit. Now, all of this stuff we're saying here is under the assumption that markets in general will hold up and that we won't have a correction, because all of these bets are off if we do. And these guys are momentum stocks: Priceline, Tesla, Amazon, all of those guys. They will run faster than normal on the way down.
Here's a question for you. How often in your analysis do you look at the macro picture first and then look at the stock?
I always look at the macro picture first, daily. I don't do anything without the macro picture, because how can I don't care how good Apple looks if the market is going to crash. I'm not calling for crashing, but I'm saying you have to look at the macro and then look at the micro within it. So how can I invest in Apple in this environment that we have? How can I invest in Google in this environment that we have? So macro comes first. I'm a fundamental trader. So I have to look at the macro picture, believe in it, and then within that macro picture, see that, okay, maybe biotechs now are okay to own because everybody hates them. There are more haters than lovers. So where are the extra seller going to come from, type of a deal. So macro comes first.
We've been on the line with Nick Shaheen, author of Create Income with Option Spreads on MarketFi. Nick, love your charts. Thanks so much for hopping on. We'll talk to you again next week.
Looking forward to it. Thanks.
Thanks,
Nick. 8:49 now. We're going to take our second break of the day. We're going to grab Gordon Johnson, surprise guest, managing director of Axiom Capital, came out this morning with a note on First Solar. We'll get his thoughts on that, and then I promise I'll also throw in a question about steel, since you were talking about it there in the chat, a few of you. So we'll ask Gordon Johnson about First Solar and steel when we come back in a moment. Welcome back, traders and investors, to Benzinga's Pre-Market Prep. I'm Spencer Israel here with Joel Elconin and Dennis Dick. We're on the line now with Gordon Johnson of Axiom Capital Management. Came out this morning with a note on First Solar, initiated with a $21 price target, I believe. Gordon, give us some insight why you initiated First Solar at a sell and what went into that price target number.
Yeah, sure. So, as you guys know, you guys have been covering First Solar almost as long as I have. The company has had, quite geniusly, we would add, a number of projects that allowed them to report earnings that we believe were much higher than what should have been reported. Not should have been reported, but rather would have been reported. They had legacy projects that had PPAs that were signed pre-natural gas collapse, and thus they had very profitable revenue and earnings. Those projects are gone. And in fact, and recently they lost their largest, most profitable project, Tribal Solar, due to a dispute with an Indian tribe in the land they were trying to build the project on. So their two largest projects currently, California Flats and Moepa, have margins we believe in the single digits, and we believe the rest of their projects have similar margin profiles. Thus, think about this. First Solar is investing $900 million into an unproven technology where if they execute flawlessly, their costs will be 22 cents a watt by 2020. Module prices today are in kind of the low 30s range, and they fell 35% in 2016 after falling 10% in 2015. So arguably by 2020, module prices will be well into the low 20s. If that indeed is the case, the earnings power for First Solar will be sub $1. It could potentially be even loss-making. We're assuming roughly 86 cents of mid-cycle earnings power. So putting a 20 times multiple on those mid-cycle earnings, and then adding in roughly $4 associated with their YieldCo CAFD, which is another major problem for them that we don't think people understand, you get a $21 per share price target. We think that's actually aggressive. We think we're being aggressive in our assumptions. We're assuming roughly 22% margins in their module business, steady state. We're assuming roughly 23% margins in their project business, steady state. We're assuming roughly 7% margins in their systems business, steady state, as well as a 20% tax rate and $30 million in annual non-controlling interest contribution. Now, keep in mind, CAFD, or 8.3, which the ticker is CAFD, which is their YieldCo, we believe has major issues. And the reason is CAFD uses non-amortizing revolver debt when they should be using amortizing term debt like every other YieldCo. At some point, they're going to have to amortize that debt. And when they do that, their dividend yield is probably going to get cut in half, which effectively would be a major headwind to the stock. This is the equivalent, the real world equivalent of buying a house with a 3-year interest only loan and telling people you have disposable income. You guys understand why that's not the case. So the issue facing First Solar is Jinko Solar reported costs in the fourth quarter of 16 of 34 cents. Those are costs that were down 7 cents per watt over the course of last year. So by 2020, I would argue that these Chinese module guys will probably have costs in the teens, which would be below First Solar's goal of 22 cents per watt, and thus render their Series 6 technology, again, which they're investing $900 million in, and again, unproven technology, will render it, basically non-competitive. And the risk to being short First Solar was they had all these projects that, again, had these great margins, and now those projects are gone. So now the company has to compete on the merits of its technology, and quite frankly, I don't think they can compete against the Chinese. We've seen this game play out before when First Solar stock was $200 and fell to $12. I think we're now back in the dark ages, if you will, for the U.S. solar guys, where they're just going to simply have to compete on the merits of their technology, and unfortunately, they can't do that versus the Chinese.
Gordon, I also want to ask you real quick about steel stocks. You've come out pretty negative on those.
For you, is the
Joel, do you have a question? Okay, I'll continue with my question then. Yeah, so Gordon, you've come out pretty negative on the steel stocks.
Is the change in...
All right, I don't know what's going on there with Joel. Sorry about that. Has your thesis on steel stocks changed at all since since the election? It's been on a rally, the whole industry. Can you give us an idea of whether you're still negative on that, or how that's changed?
Yeah, we're still negative. I mean, At the end of the day, we think a lot of people have lost sight of what drives steel. It's China. The U.S. consumes about probably 6% of the world's steel. China consumes probably about 50% of the world's steel. So the steel sector is going to live and die with China. And what's going on in China right now is rather significant. Keep in mind, last year, 2016, basically the middle of through the second half of 2015 and through the first quarter of 2016, Steel stocks, commodity stocks got absolutely annihilated. And the reason was because China had tightened. China started tightening in 2014 and started to affect the market in late 2015 and continued through 2016. But in November of 15, China came out and said, okay, we're going to loosen. And nobody believed them. And the stocks got crushed through the end of March. And then if you would have been long those stocks, it would have been the trade of the century. China is now tightening in a way that we've never seen. Yesterday, they announced that they're cracking down on the ability to speculate in commodity markets. They last week said that they're investigating and they're doing a joint unification between their regulatory agencies to crack down on the ability to speculate in wealth management products. We know that in January, for the 70 cities that China tracks, year-over-year prices for houses were down 0.1%. Now, to put that in context, prices before December where prices were flat, prices were up 18 consecutive months in a row. The last time we saw prices decline at all, it marked like a 16-month consecutive decline in prices, which crashed metals prices, et cetera. So we believe the tightening in China is at some point going to cause metals prices to collapse. And we think it's going to happen this year. With respect to the U.S., we've done the math on Trump's infrastructure plan. And clearly, we don't know what the plan is. But if you look at the most robust version out there, the white paper that Wilbur Ross put out, we've done the math on it. And it's just not significant enough to add to global steel demand. And I think that here's the reality. People have got excited about Trump, there's no doubt about it, not just in the stock market, but in the actual steel market. We believe that people have built inventory on hopes of what Trump's going to do. Last year, in 2016, Obama announced a $350 billion stimulus package, and it did not have an effect on steel prices. What did have an effect was, there were tariffs implemented by the Obama administration on steel imports, and the steel mills used those tariffs to hike prices. Guys built inventory, there wasn't demand there, and then prices collapsed again. And it's like this rinse and repeat cycle. The point is, we believe real inventory has been built in the U.S. market on hopes of what's going to happen this year with respect to infrastructure. Even if Trump implemented an infrastructure plan tomorrow, which we know is not going to be the case, it probably wouldn't take effect until like mid to late 2018. So the point is, we think at some point this year, there's going to be another liquidation of inventory, of steel inventory, on guys who have built on optimism. And you're going to get more imports into the U.S. because prices in the U.S. right now are significantly above international. And we believe there's a decline coming in the U.S. market. That's a U.S. basis. But we also think there's a decline coming in China, which is much more important to global steel prices. So, yes, we're still negative.
You said at some point this year. Can you get any more specific with regards to when?
Just put it this way. In 2 months, iron ore prices, we don't think will be at $90.
Okay. There we go. Gordon Johnson, thanks so much for hopping on this morning. We'll talk to you again soon.
Absolutely.
All right, Dennis. Just you and me now. But Gordon, obviously,
that was great.
Yeah. So
Gordon Johnson, that was a great interview. I love Gordon Johnson he calls a spade a spade. He doesn't sugarcoat anything. All these other analysts try to sugarcoat. Gordon Johnson doesn't sugarcoat anything.
So I hope those of you in the chat who wanted to know his thoughts on steel since they've been in a rally, I hope that answers your questions. We've got about a minute left in the show. There's a few stocks that we didn't cover today. We didn't cover AutoZone. We didn't cover Hertz or Workday. And after the bell today, we got Etsy, Palo Alto Networks, AMC, Weight Watchers, Sarepta, Taser, Salesforce, Raw Stores, all report after the bell today. So that'll be on tomorrow's docket. That's about it for the day, though. Dennis, any final thoughts and any previews for any shenanigans at the Traders Expo today?
Well, and if you're in New York, obviously, come on by the New York Traders Expo. We will be there today. Obviously, is the last day for it there. I'll be back in the D tomorrow, flying in tonight. So, but, it's been a great couple days down here for us. Obviously, we've had a little technical difficulties with my trading. That was a complete debacle yesterday. I was trying to trade on an internet connection that wasn't that great, and I had 25 positions. I didn't even know what I had. So my story is I don't trade aggressively when I don't have all my information. I don't have a good internet connection, but I learned that the hard way yesterday. But been a great time in New York here. Obviously, we've had a lot of fun here, and we're looking back to being home then trading regularly tomorrow.
Great lesson. If you learn one thing from the show, it's don't trade if you don't have a reliable internet connection. All right.
That's it. There you go.
That's it. All right. That's our show for the day. Hope you enjoyed our chats with Gordon and Nick. Have a good rest of your day, everybody. We'll be back with you folks tomorrow morning.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.